Well, do you know, this morning my 5 friends along with me have decided to go to Goa this weekend. Also, one simple hack for investing is to invest in a 5 rupee stock and wait for that stock to become rupees 10 and your money will just be double. Well, do you know what's the common thing between all these statements? These statements are just myths. But what exactly is a myth? Well, myth is a widely held but false belief or an idea that is not supported by any conclusive evidence. These are mere statements. And stock market is no such exception from such kind of myths and misconception. Well, traditionally there have been various misconceptions and myths even regarding the Indian stock market. And that's why we Indians have slightly remained less invested in Indian stock market when compared to foreign nations. But things seems to be changing now as more and more millennials are starting with their trading and investing journey. And that's why it's our responsibility to help such Indians start with their trading or investing journey and keep them away from general misconception or myths that usually surround the market. But before moving on to our main video, guys, we have an exclusive surprise only for our YouTube viewers. Only by clicking on the link in the description below, you will get 2 months extra access of LearnApp subscription. So what are you waiting for, guys? Do check out learnapp.com. So the first myth in our bucket list is lower PE ratios automatically means a stock is a good buy. Now, before moving on, here is a disclaimer, guys, that we by no means are ignoring the importance of PE ratios. But the problem is over-dependence or over-usage of PE ratios can make a person slightly biased. And in such a situation, they can ignore other crucial parameters that are very important for a stock analysis. Let's understand this with an example that why PE ratios might not represent the whole complete picture. As you can see in this chart, we have the Nifty sectoral PE values as of 31st August 2021. As we can see here, Nifty FMCG has the highest PE while Nifty Oil and Gas and Nifty Metal have the lowest PE ratios. If one would weigh only the PE ratios of these sectors, then clearly the metals and oil and gas sectors would be the easy picks. But now let me add another column of returns on equity. As you can see here, Nifty FMCG has the highest returns on equity while Nifty Metal and Nifty Oil and Gas are one of the sectors that have the lowest returns on equity. So that's the first problem with the PE ratio, that they usually ignore the growth aspect that the particular company or that particular sector is experiencing. And thus, as we can see here, Nifty FMCG and IT have higher growth rate, and that's why they command higher PE ratios when compared to the low growth sectors like metals and oil and gas. And that's why one better metric than PE ratio can be PEG ratio that adjusts the PE ratios with the growth rate, with the EPS growth rate of the company. Thus, a higher PE ratio with higher growth rate can be more justified when compared to lower PE ratios with low or no growth rate. Another drawback of exclusively relying on the PE ratio is that the PE ratio ignores the qualitative aspect. Let's understand this with another example. We have the sectoral PE ratios of the Nifty Private Bank and Nifty PSU Bank. While if we look at the PE ratios, then clearly Nifty PSU banks are the most undervalued. And we also know that PSU banks enjoy a major market share in the Indian banking system. But then the question arises that why such PSU banks are valued so low? Well, the answer lies in the management inefficiency and poor corporate governance. We know over the past few years, PSU banks have faced several frauds and defaults due to which their asset quality has deteriorated and their NPAs have significantly gone up. But the PE ratio totally ignores this qualitative aspect. And if you are a beginner, you are most likely to fall in this low PE trap. So the second myth in our bucket list is the stock prices are too high, they have to fall, and then only I will buy. Well, this is the I will wait for correction wala syndrome. Well, do you know, most of the finance professionals are totally against this concept of timing the market. In a September 1995 interview with Worth magazine, the legendary Peter Lynch put it this way: far more money has been lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves. Let's understand this situation with an hypothetical example. So let's just assume this is 2005 and we have Rahul and Anjali who both have rupees 1 lakh to invest in HDFC Bank. Now Rahul was a very cautious guy and found the value of HDFC Bank at that time very high and thus decided to wait for correction whenever it will come. Assuming he bought the stock at the lowest in the 2008 market crash, his buying price was around rupees 135. While Anjali did not believe in the timing of the market concept and invested right away her rupees 1 lakh when market price was rupees 55. Now fast forward to today, taking into account the stock splits, timing the market wala attitude has costed Rahul a major 1.69 crore rupees. Therefore, try to invest in the opportunities that are available right now. Do not believe in any concept like timing of the market. Remain invested with the fundamentally sound companies and enjoy the power of compounding. So the third myth in our bucket list is lower the stock prices, cheaper is the stock. Now, this is another general misconception that we keep hearing about a lot, that when a particular stock is priced lower in absolute terms when compared to its peers in the similar industry, that particular stock is undervalued. Well, let's again understand this with a very interesting example. Let us have a look at 4 FMCG stocks, that is HUL, Nestle, Britannia and Procter & Gamble. If we look at their market prices, then one would be convinced to think that HUL or Britannia is a cheaper stock than Nestle or P&G. But do you know, to actually compare the prices of these stocks, the value of each share must be the same. So for that, let's just add another column of face value of each of these shares. So as we can see in this table, the face value of HUL and Britannia is rupees 1, while the face value of Nestle and P&G is rupees 10. Therefore, to compare their prices, you need to either multiply the prices of HUL and Britannia by 10 or the prices of Nestle and P&G by 10. So let's just multiply the prices of HUL and Britannia by rupees 10. Now looking at the adjusted prices, will you still say that HUL and Britannia cheaper than Nestle and P&G? Of course, the answer is no. Therefore, lower stock prices does not necessarily mean that a particular stock is undervalued. So the fourth myth in our bucket list is that gold is a safe investment. Now, of course, you might have heard this statement or you might have came across this statement from your grandmother or grandfather.
Gold is my God.
But do you know, for any investment to be considered as safe, they need to generate stable returns consistently over a very long period of time. But let's just analyze the historical returns of gold. As you can see in this chart, returns from gold tend to be more random and erratic, just like any other financial instrument. Now, the primary reason why gold is not able to generate much stable return is because lack of application apart from jewelry and electronic devices. Like most of the gold just remains idle in either your lockers or vaults. As you can see in this chart, most of the gold is stored as reserves with the respective central banks of the nations. Now, this doesn't mean that gold is a bad investment. However, just like any other asset classes, you need to remain invested with gold for a very long period of time. If you remain invested with gold for a very long period of time, then there are chances that you will be able to earn returns that will beat the inflation benchmark. However, if you take into consideration the shorter duration of time, then you can see in this chart the inflation rate was much higher than the gold returns. And that's why to actually reap the benefits of investing, you need to remain invested with gold for a very long period of time. Thus, investing in gold is not a problem, but considering gold a safe investment, that might be a problem. So the final point in our bucket list is that lower NAVs, that is net asset value, means a good mutual fund. Now, as investors' participation is increasing in Indian stock market, mutual funds are emerging as an appropriate tool of investment. Also, according to Association of Mutual Funds data, India saw its largest ever jump in the number of SIP accounts opened in June 2021. Thus, investment in mutual fund is becoming part of each and every day's life. However, there is another misconception that surrounds this mutual fund industry, that a fund that is having a lower net asset value is a better fund in comparison to the fund that have the higher net asset value. Now, NAV is nothing but consider it as the per unit value of a mutual fund. That is, if you want to buy a unit in that particular mutual fund, you need to pay an amount that is equal to the NAV of that fund. Thus, the NAV of a mutual fund can be as low as rupees 5 to as high as rupees 500 or 600. But it doesn't guarantee by any means that a lower NAV fund is a better fund. Let's better understand this with an example. Fund A has an NAV of rupees 10, while Fund B has a NAV of rupees 100. Both are equally diversified and consider them as equity-oriented funds. Now you have rupees 10,000 in each of these funds. In Fund A, you will be allotted 1,000 units, and in Fund B, you will be allotted 100 units. Now let us assume that after 1 year, both the funds give 10% return. As you can see, if the returns given by the funds are the same, then having a lower NAV or holding more number of units does not make a difference in the final return on investment. Therefore, whenever you are looking for a good mutual fund, don't just run after or don't just assess a particular mutual fund solely on the basis of NAV. There are various other factors that you need to look after for analyzing mutual fund. So guys, these were all the 5 myths that usually surround us. But guys, hold on a second. If you really found this 10-minute video useful, let's just imagine the quantum of knowledge you will get by going through our extensive and well-researched courses exclusively on learnup.com that are taught by the great industry leaders. Because it is no hidden fact that be it trading or investing, when done with proper knowledge or skill, can actually unlock a box full of wealth. That's why do visit learnup.com. Also, we have some great courses out there exclusively taught by the leaders in the market. And not only this, we have regularly live workshops running that will help you gain more practical insights in the live market and directly ask your various questions and your queries with the mentors. If you will sign up using the link exclusively in the description below, you will get 2 months extra access of LearnUp subscription. Also guys, apart from these 5 myths, any just random myth you came across regarding stock market, just put it in the comment section below. And guys, if you really love this video, do subscribe our channel because that really motivates us to push such more content. Do watch these 2 videos the next time and keep supporting us. See you in the next video.